Ahead of the November FOMC decision, the pace and outlook for inflation remain challenging as private demand slowed to a crawl and employers show signs of pulling back on wage gains amid growing uncertainty over the outlook for activity. The market therefore looks straight past the 75 basis point hike delivered in November to the detail and tone of the accompanying guidance. In the statement, 2 points are added. One to highlight the need for contractionary policy for an extended period, and another to recognise that policy has already been tightened materially, with the full effect of these decisions still to come. The phrase, in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time, speaks to the FOMC's belief that demand is still in excess of supply, leading to persistent inflation risks. This is true both of consumer prices, which are growing at a multiple of the FOMC's 2% target, and also to the labour market, where the unemployment rate is near record lows and nominal wage growth remains elevated. In the past few months, however, the data has provided clear evidence that the rapid tightening of policy undertaken by the FOMC is having an effect and that supply concerns are receding. With respect to consumer price inflation, not only has the wave of goods inflation experienced through 2021 and early 2022 now abated, but we are also beginning to see price pressures associated with the service sector reopening of 22 ebb. Ahead, it looks as though US consumer inflation will be dictated by prices largely out of the control of the FOMC, such as food prices, and those that are, in some respects, positively related to interest rates, like rents, with institutional investors active in the rental market looking to keep the return to investors ahead of rising treasury yields, while higher actual and expected funding costs delay the pipeline of new construction. When assessing the outlook for the US economy and monetary policy, it is also important to recognise that private sector wage and benefit growth looks set to be entering a downtrend. Private sector total compensation having slowed from a near 6% annualised pace in the June quarter to around 4.5% in the 3 months of September. Household consumption and business investment also slowed to a crawl in the September quarter, and forward indicators point to building downside risks. Now, one outcome certainly does not make a trend, but with the stance of policy already contractionary and the lags associated with policy often long, immediate momentum in key indicators like private wage growth and employment must be carefully assessed and factored in. We see this now occurring at the Federal Reserve, with the FOMC committee to take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. So what does the road ahead for US monetary policy look like? We remain confident that the December meeting will see a reduction in the pace of tightening by the FOMC, with a 50 basis point hike forecast. The next meeting at the end of January will likely see another reduction in the scale of rate hikes to 25 basis points, assuming current trends in inflation, wages and employment persist. Westpac believes that the resulting Fed funds rate of 4.625% is tight enough to get inflation back to target in time. However, it was clear from the press conference that Chair Powell still sees inflation risk as biased to the upside, potentially creating need for the committee to continue raising at a slow pace towards the middle of 2023. For these decisions, as of much significance as the activity and price data will be real yields across the curve. If these benchmarks remain materially above zero, the FOMC will likely be comfortable to remain on hold from the March meeting. But if the market immediately turned from pricing rate hikes to rate cuts, the FOMC will likely see a need to sustain the hiking cycle to hold up term interest rates and restrict inflation, with the economy at risk of recession as a result. Interest rate cuts are unlikely to come onto the FOMC's agenda until 2024, and even then, we suspect that policy will be normalised towards a neutral level slowly over the 18 months to June 2025. We'll see you next time.